Welcome back to Investinality, your go-to resource to weather all market conditions. Today we'll be going over the PEG ratio. I'll walk you through what it stands for, how it's calculated, a few clarifying examples, and some of its limitations. So let's get to it. Before we begin, I want to make it crystal clear that the content provided in this video is solely for educational purposes and should not be considered as financial advice. The views, opinions, and strategies presented herein do not constitute recommendations to buy, sell, or hold any securities or investments. Investing involves risk, including the potential loss of principal, and past performance is not indicative of future results. Viewers are encouraged to conduct their own research and consult with a qualified financial advisor or professional before making any investment decision. The presenter of this video is not liable for any financial decisions made by viewers based on the information provided. Each individual is responsible for their own investment choices and should carefully consider their financial situation, risk tolerance, and investment objectives before proceeding. By watching this video, viewers acknowledge and agree that they are solely responsible for any investment decisions they make and that the presenter and this channel bear no responsibility or liability for any outcomes, gains, or losses resulting from such decisions. Great, so now let's get to it. So to start off, let's go through the definition of the PEG ratio. So now PEG stands for PE to growth. The PE part of the PEG ratio refers to the price to earnings, which is also known as the price to EPS or price to earnings per share. If you'd like to know a little bit more about the EPS, make sure to check out my video on the EPS. I added a link in the description below. Growth refers to the EPS growth, also known as the earnings per share growth. Now let's look at the calculation of the PEG ratio. Now, the PEG ratio is equal to the PE divided by EPS growth. And remember, the PE is equal to the price divided by the EPS. Now let's walk through some examples. Imagine we have a hypothetical company XYZ. The current market price of XYZ is $20. Company XYZ has an EPS of $2. Company XYZ also has an EPS growth of 20%. Now let's insert these numbers into our formula to get a sense of what this company's PEG ratio would be. We start with the price, which is $20. We divide that by the EPS of $2. Finally, we divide that by the EPS growth, which is 20%. $20 divided by $2 results in 10, and 10 divided by 20% results in a PEG ratio of 0.5. Now what does this mean? Well, a PEG ratio below 1 denotes that a company is undervalued, whereas a PEG ratio above 1 denotes that a company is overvalued, and a PEG ratio at 1 denotes that a company is at market value. A PEG ratio of 0.5 shows that this company is currently undervalued, given that its earnings per share growth is greater than its current PE ratio. Now let's walk through a hypothetical example to get a little bit more clarification on how the PEG ratio can be helpful. Let's imagine two companies. Company A has a PEG ratio of 0.5. Company B has a PEG ratio of 1.5. Now, this means that Company B is currently at 1.5 times its expected EPS growth. On the other hand, Company A is at 0.5 its expected growth. So to put this into perspective, we can see that Company B has already priced in the EPS growth as compared to Company A. So if Company A's PE were to increase, or its growth to decrease, then holding the growth rate constant, if Company A's price were to increase, it would then be able to also reach 1.5, making Company A a potentially more enticing, profitable investment. Now, let's put this into perspective with three different companies and compare which of them would be most profitable based on their PEG ratio. One thing to consider with these companies is to make sure we're comparing apples to apples rather than apples to oranges. Now imagine we have these trends. Company A has a decreasing PEG ratio, Company B has an increasing PEG ratio, and Company C has a somewhat steady PEG ratio. Now which of these seems like it would be most profitable? Well, given what we know that a lower PEG ratio can potentially show an undervalued stock, we can see that Company A has a decreasing PEG ratio. Whether it be due to the PE and or growth, this company is showing that it has the potential to be worth more. On the other hand, let's look at Company B. Company B has an increasing PEG ratio, in which case it is showing us that the PE ratio with respect to the growth rate is growing higher than what the company may actually be worth. On the other hand, we have the somewhat steady Company C. This shows us that Company C is not seeing a general trend in either its PE or its growth rate, making it not as enticing given all else being equal. Now let's look at the concept of comparing apples to apples rather than apples to oranges. What do I mean by this? Well, imagine that we have three companies in the same sector. Company A has a PEG ratio of 1.4, whereas Company B has a PEG ratio of 1.8, and Company C has a PEG ratio of 1.6. Although it seems like all of these PEG ratios are overvalued given they're above 1, we can note that the industry average is actually 1.6, meaning that Company A can be said to be undervalued with respect to the industry average. Company B can be said to be overvalued with respect to the industry average, and Company C can be said to be at the market average. So this is just a reminder to compare apples to apples rather than apples to oranges when analyzing the PEG ratio. Great, now let's walk through the final step, which is the limitations the PEG ratio has. Now, some of the limitations the PEG ratio has are its short-term focus, the industry variability, the concept of cyclical companies, the concern of a negative PEG ratio, and the earnings growth estimate value itself. So let's start off with the short-term focus. Trying to analyze what a company will do in the future is very difficult given that conditions are constantly changing over time, and how a company reacts given new features, new management is difficult, if not impossible, to forecast. This makes the PEG ratio not necessarily gauge what the company's potential is in the long term. Next up, we have the industry variability. Now, every industry has a different average PE ratio. Some have higher on average, some have lower on average. So when comparing companies, we have to make sure to compare apples to apples rather than apples to oranges. On the other hand, there's also the concept of cyclical companies. I went over this in my price to earnings video, so make sure to check that out if you're interested in learning more about that. Fourth up is the negative PEG ratio. Now, negative PEG ratio doesn't show us very much in the sense that a company is not showing profitability at the moment. A PEG ratio can be said to be helpful when comparing two profitable companies as compared to a less profitable company, a company with a negative PEG ratio, with a profitable company, a company with a positive PEG ratio. Due to this, negative PEG ratios, when compared to positive PEG ratios, don't offer us as much as a positive PEG ratio can to another positive PEG ratio. And fifth up, lastly, is the earnings growth estimate. Now, this estimate is on a futuristic term and varies based on different factors. Different analysts are going to be using different time frames, which in turn changes the PEG ratio. Given this, make sure you understand what time frame the analyst is using, whether it be 1 year, 2 year, even 5 years, and whether that is a realistic implication of the company continuing its current profitability. Great, and there you have it. We've gone through the definition, walked through the calculation, looked at some examples, and considered some of the limitations of the PEG ratio. Thanks for watching. Remember to subscribe to our YouTube channel, Investinality. Make sure to drop a like and leave a comment with any other investment terms you'd like me to go over. Thanks again, and until next time.